All right, testing 1 2. Sorry about earlier. I didn't hit the record button for the volume. So anyway, I'm still a newbie at this. Anyways, let's look at something real quick before this disappears. This is the time in sales. When the market is open, this is ticking up and down as far as the buys and the sells. Now, I'm not sure how accurate this number right here is, but 1830, I guess that's what, 630. Somebody bought 1,760,524 shares of SPY at 529.78. Um, I'll let you do the math. Wow. Okay, so here's what little old chicken trader Odell did today. So first off top, SPY on the 3 minute candle. Opening print range was what's that, 66 cents? Yeah, 66 cents on this candle. Resistance 526.37. Support 525.71. All right, now when this happened today, when I got in, there was a PPI or CPI number or whatever that was announced at 8:30. So as you can see, the market loved that number because we shot up on this candle right here at 8:30 when that number came out. So this was a high bubble of 527 this morning in the pre-market. So what I did was I just took that line and carried it over as a resistance area or a supply zone for you technical traders out there that are learning all these chart patterns and all this trading lingo. I won't call any names, but her initials are my daughter Brianna. Sorry, I had to do that, babe. But anyway, this right here was the resistance at 527. So when the market opened and we had the first 3 minute candle break the resistance level here, technically this should have been a trigger to get calls. However, for me, I was a little nervous because I knew that area was up here and I didn't want to take the trade until this level was breached. Now, I did eventually get in at 940, which was between this candle and this candle here in anticipation of this going up. So let me pull the actual trade ticket over so you can see. So at 940 is when I got in the 526 calls for 384 4 contracts. I think this was like one strike in the money. The delta was like about a 54 55 because I had anticipating getting in and getting out quickly. So I got in 940, and 940 is about right here in between these two candles, like I said earlier, and we pushed up. I was looking good on my trade, and it's like, okay, if we can just get through this level, I'll be fine. Well, lo and behold, we didn't make this level. There was a bunch of sellers here, and they pushed this down. Now, because I was trading 7 days out or 6 days out, my stop range was really tight. I think it was at about maybe this level, someplace in here. It was actually above this support level here. So seeing that I actually closed, or I stopped, or I canceled my stop order to get out. Had I not done that, I would have gotten stopped out on this candle here. So seeing that, I decided to get in some puts, and that is what I did. I got in the puts at 945, which was on this candle here, and then at 940 or 950, 5 minutes later, I got out of those puts with a 6% profit on 3 contracts. We bought them 1, 2, 3, sold them 1, 2, 3 right here. So we bought them for 352, sold them for 374. I think that's 22 bucks a contract times 3, $66. No big deal. So now, this started happening. So I was like, okay, well, my calls are in trouble. I'll just hold them for a little while. I had all intentions of holding up until about maybe 11 o'clock to see if the market would turn around and come my way. So I actually took my focus away from this and turned my focus on to SPX. Now, before I get to SPX, what happened there, you can see that I eventually got out of those calls at 10:43. So we were in that trade for a little less than an hour, and at 10:43, that is about right here, someplace in here is where I got out. And as you can see, it pretty much held the line and stayed there pretty much all day. The rest of the day just stayed up above. So technically, the trigger worked, but I would have gotten stopped out on my loss had I held it here. But then again, I would have got back in on puts, made some money. But if I would have gotten stopped out, I would not have made as much money on spot as I did today. So the $96 for the 4 calls and the $66 for the 3 puts translated to be about $162 less commissions and fees on SPY. So that's where we were on SPY today. Now, let's talk about SPX. Okay, so here's the chart on SPX. I got a 3-minute here. This is an 8-minute, and then this is the 15-minute. Now, on the 15-minute, I didn't put my ORB on. Let's see if I can slip that on here real quick. Give me one moment. Tell you what, I don't have time to go through all that, so we'll just use the middle 8-minute chart to show you what the ORB was, which is the opening range bar. This is actually the opening range bar on the first 15-minute candle. So these lines translate over to here. I just don't have them on the chart. So anyway, first 15-minute candle on SPX printed out with a high 52.79.26 and a low of 52.70.69. Nice little range here. So now we actually took a while for this to actually trigger. It came in almost 11 o'clock. We're actually at about 10:36 is when we broke to the upside. So this is where I took puts. I was bullish by using puts. And here is the ticket. I'm going to slide it over here. And this is what we did with our puts. We got, let's see, 1, 2, 3, 4 contracts on puts, bull puts. So that's 1, 2, 3, and 4. Yeah, that's right. So we got 4. We got 30 cents credit on 4 of those. So 4 times 3 is 12. So that's $120 for those 4 puts that we got. And we basically did not look back for the rest of the day to the downside. My short strike on those puts was 52.50. That's a short strike, so that's the line in the sand. That's where we do not want to go below and breach before the day is over for expiration. So as you can see, that 520 line is 52.50 line is here in the sand, and it basically held all day on the 15-minute chart and did not look back. So me being the chicken pig trader that I am, I decided, hey, we're at all-time highs, because I remember where we were on that SPY chart earlier. I'm thinking we might not go too much higher, so I decided to be greedy and bring some calls into the picture on the bear calls to got me into an iron condor. So now let me see if I can get that chart back. Oops, there it is. So I entered calls at a bear call at 12:23, which was 12:23, which was right about here, in between these two candles here on the 15-minute chart. So I was like, okay, we can't go much higher than this 53.10 right here. So that's what I got. 53.10. We sold at 53.10 and bought. Let me see if I can get them back. Oh, I can't get him back, so let's do this again. Give me a second, I'll get him back over there. So we sold the 53.10 and bought the 53.15 for protection. We got another 30 cents credit for another 4 contracts. Now, this put me in an iron condor, and with the iron condor, you have 2 verticals that are in the same expiration period, thus our iron condor. You got a top and a bottom credit. So we got $120 credit for the bottom side on the bull put, and we got $120 credit for the top side on the bear call. So we had a total credit of $240 that was taken in on this trade. All SPX needed to do was to stay below 53.10. All right, remember that, 53.10. Matter of fact, I got 53.10 on my chart, and on the 8-minute chart, we'll take a look, and this is what it did. It breached right at the close. It went up to 53.11.76 on the last 8-minute candle. Now, I was down big in this trade. I think I was down like $600 because it breached my level. So I'm at the computer looking at it like a deer in the headlight. What do I do? And I'm like, okay, well, it's XPX. Nothing I can do now to close it. So I'll just take my licking and come back and play again tomorrow. Well, lo and behold, the SPX gods pushed this sucker down, and it closed right here at 53.0815. 53.0815 minus 53.10. What's that, $1 and some change, where it came back down within my level. So that was my heart attack roller coaster ride for today. But on the good side, we keep all of the credit, the full $240, plus the other $162 we made today on SPY. I'll let you do the math. Crazy wild day. What's that, $400? So yeah, I'll take that. Now, one thing that I've learned today is I'm not gonna be greedy on the SPX anymore by trading condors that early. If I do a condor in the future, I'll probably throw it on the last hour or so before the market closes, because this was a little gut wrenching today. I had alerts set all doing down these levels, and they all just started chiming off right as the market was getting ready to close. Now, daughter wanted me to talk a little bit about the options chain. So let me pull one up here and get it slid over for her. Okay, here's the options chain. I got this option chain is on SPY. Let's do Apple. Alpha Papa Lima. All right. On the Apple options chain. So on the Apple option chain, let's just pick this from May 16. So this guy it expires on the 31st of May, which is the end of this month. You got 16 days left before these options expire. So that's what the little 16 inside the little parentheses mean. This is your call side, and this is your put side, all the way on this side. This is your bid and ask. You sell them at this level here, and you buy them at this level here. So if I wanted to buy the 190 call option on Apple, it will cost me $252 per contract. If I wanted to sell those, I could sell them for $246 a contract. I liked having delta and open interest on my chart, on my options chain, just to see where we are. So right now, the 190 strike has 9,411 contracts that are open for people to do business with, and the delta is 51. Delta can tell you a lot. A quick, dirty thing or easy way to remember what delta is just the rate of change for the option price according to every dollar move in the underlying. So basically what that means is, for every dollar that Apple moves, the option strike price will move 51 cents. So if Apple is trading at $190 and it's almost there now because it's at 189.72, that's where it closed at today. So if I bought one call contract, it's going to cost me $252. And if Apple goes up $1 in price to 191, my option, this 252, will go up in value by 51 cents. That's what this basically means right here. So a lot of people like to buy out of the money options. So let's use an out of the money option on for an example on this one. This black area right here is considered out of the money on the call side. So every level from 190 all the way up to 215 is out of the money. If I go and get all the strikes, everything from 190 all the way to 265 is out of the money. In the money on the call side is everything shaded. Okay, so at 180, this guy is in the money because it's in the shaded area. So on the put side, the black area or the unshaded area is out of the money and the shaded area is in the money. At the money will be considered the 187.50 on the put side, and at the money on the call side would be 190 because it's not shaded here. Okay, hopefully that was clear as mud. Now, out of the money call option, let's say somebody was wanting to buy the 195 call option, they would buy it for $74 per contract, and if Apple moved $5, that $74 contract will be worth $252. That's the beauty of options working in your favor, giving you leverage. So again, if you buy, let's even do this one, this will even be better. Let's say you buy the 200 call strike that expires in 16 days. You would pay $19 per contract. If Apple goes to $200 in the next 16 days, this level will be shaded. It will be purple. It will be in the money. So this $19 call option will be worth $410 if it moves to $200 because that will be in the money. All right. Hope that was clear. In the money, at the money, out of the money. In the money, at the money, out of the money. Everything from 187.50 on down to 160 is in the money on the call side. At the money on the call side is 190 strike price. Out of the money is anything 192.50 on down. Okay, so there you have it. I hope the recording volume is up this time. I'll check in a second. But anyway, happy trading and good night.